Shri Gurubhyo Namaha. Welcome to our online teaching academy, Ekalaiva. Cbse Class 12, Economics, Chapter Balance of Payments. This chapter covers the meaning of foreign exchange and exchange rate, the types of exchange rates, sources of demand for foreign exchange, sources of supply of foreign exchange, and appreciation and depreciation of currency. Each country has its own currency. For example, USA's currency is US dollar, UAE's currency is dirham, Japan's currency is Japanese yen, and India's currency is rupees. Then what is foreign exchange? Foreign exchange refers to all currencies other than the domestic currency of a given country. India's currency is Indian rupee. All other currencies other than the Indian rupee is called foreign exchange. Pound sterling, yen, dollar, and euro are foreign currencies. Foreign exchange rate is otherwise the price of a currency expressed in terms of another currency. The exchange rate is the rate at which one currency can be converted into another currency. It is also called as the external value of domestic currency. Suppose an Indian firm imports $5 worth goods from America. The Indian importer has to convert Indian rupees to American dollar to make the payment. If the rate of $1 is equal to rupees 70, and if the importer has to pay $5, it means he has to pay rupees 70 into 5, rupees 350 to America in terms of foreign currency. Types of foreign exchange rates. There are three types of foreign exchange rates: fixed exchange rate system, flexible exchange rate system, and managed floating rate system. Fixed exchange rate system is otherwise called as pegged exchange rate system. Flexible exchange rate system is otherwise called as floating exchange rate or free exchange rate system. And managed floating rate system is otherwise called as dirty floating rate. Let us go into the detailed explanation. Fixed exchange rate system. Fixed exchange rate system refers to a system in which exchange rate for a currency is fixed by the government. It means government has the complete authority in fixing the exchange rate. Here, the rate does not vary with the demand and supply of foreign currency. The basic purpose of adopting this system is to ensure stability in foreign trade and capital movements. Government fixes this rate through the central bank of the country, that is, through RBI, Reserve Bank of India. Another type of exchange rate system is the flexible exchange rate system. Flexible exchange rate system refers to a system in which exchange rate is determined by forces of demand and supply of different currencies in the foreign exchange market. Flexible exchange rate system is otherwise called as market exchange rate system or free exchange rate as it is determined by the free play of market forces of demand and supply of foreign currencies. This is also called as floating exchange rate because there is variation in prices. The exchange rate is determined by the market through interactions of thousands of banks, firms, and other institutions seeking to buy and sell currency for the purpose of making transactions in foreign exchange. The third type of exchange rate system is the managed floating rate. This type of exchange rate is managed by the central bank of the country. Managed floating rate refers to a system in which foreign exchange rate is determined by market forces and central bank influences the exchange rate through intervention in the foreign exchange market. This managed floating rate is otherwise called as dirty floating rate. Central bank intervenes in the foreign exchange market to restrict the fluctuations in the exchange rate within certain limits. The aim is to keep exchange rate close to desired target values. When the central bank finds the floating rate too high, it starts selling foreign exchange from its reserve to bring down the rate. At the same time, when it finds the rate too low, then it starts buying to raise the rate. Sources of demand for foreign exchange. Why is foreign exchange demanded? For importing goods and services, for making transfer payments, for making income payments, for making investments abroad, for lending money, and for making repayments to foreign countries. Now, why do we need foreign exchange when we import goods? We import goods like cell phones or television or other electronics. Payments for imports are made in foreign exchange. For example, when an importer imports cell phones from America, then he has to make payments in terms of dollars. Hence, he demands foreign exchange when he imports goods and services. Foreign exchange is demanded for making transfer payments. Transfer payments are otherwise unilateral payments. They are otherwise one-sided transactions. Few examples are gifts, donations, scholarship, etc. Such payments are made in terms of foreign currencies. Then we demand foreign exchange for making income payments. Demand for foreign exchange arises for the payment of income in the form of rent, wages, interest, dividend, etc. For making investments abroad. Investment in rest of the world is an important business activity. We need the currency of that country where we need to make investments. US dollars are demanded if investment is to be made in USA, or yen is needed if we have to make investments in Japan. And finally, we demand foreign currency for lending money to other countries, for making repayments to foreign countries. Sources of supply of foreign exchange. A country receives foreign exchange through different sources. Export of goods and services is an important source of supply of foreign exchange from the rest of the world. Export of goods and services from India to USA would mean supply of foreign exchange to India. Transfer receipts is also one of the important sources of supply of foreign exchange. Gifts, donations, grants, remittances by families, staying abroad are also an important source of supply of foreign exchange from the rest of the world. Foreign exchange also flows from the rest of the world to our country by the way of income receipts like profit, wages and salaries, dividend, etc. These refer to the factor incomes from abroad to our country, from investments in financial and physical assets made by the rest of the world. The amount which foreigners invest in our country increases the supply of foreign exchange. And these investments include FII and FDI. FII is foreign institutional investment and FDI is foreign direct investment. And finally, there is supply of foreign exchange, or there's inflow of foreign exchange through borrowing and receiving repayments from the foreign countries. A loan from USA would mean flow of dollars from USA to India. This contributes to the supply of foreign exchange to India. Currency depreciation and currency appreciation. Appreciation and depreciation takes place due to market forces of demand and supply of foreign exchange. It takes place under the flexible exchange rate system. Currency depreciation refers to the fall in the value of domestic currency in terms of foreign currency, whereas currency appreciation refers to the increase in the value of domestic currency in terms of foreign currency. In other words, when price of foreign currency in terms of domestic currency rises in the foreign exchange market, it is termed as depreciation of domestic currency. On the other hand, when the price of foreign currency in terms of domestic currency falls in the foreign exchange market, it is termed as appreciation of domestic currency. Currency depreciation makes domestic goods cheaper in foreign country as more of such goods can now be purchased with same amount of foreign currency. And this leads to increase in exports. Currency appreciation makes foreign goods cheaper in domestic country, as more of such goods can now be purchased with same amount of domestic currency. So this leads to increase in imports. A change from $1 is equal to rupees 70 to $1 equal to rupees 75 represents that Indian rupees is depreciating. When the exchange rate rises from $1 is equal to rupees 70 to $1 is equal to rupees 75, this means that more rupees is needed to buy $1. A change from $1 is equal to rupees 75 to $1 is equal to rupees 70 represents that Indian rupees is appreciating. This means that less rupees is needed to buy $1.